So three things I want to talk about today. One is the U.S. lending market broadly, the players and how it's evolved since the GFC. The second is alternative lenders or debt funds, the market opportunity there and how returns are created. And then the third is relative value for debt investors today, both in the context of historical as well as against the equity in the same transactions. I thought I would spend just 2 minutes on real estate markets and equity pricing and kind of sum up what we've heard this morning very broadly. I think they're an important backdrop for any discussion of debt or relative value is the collateral you're lending against. So really broad brush, real estate markets are balanced. You heard it this morning. Supply and demand is relatively in check. Occupancies are rising. We're seeing cash flow growth. In this environment, a lender can take comfort in basis protection that real estate provides. The second general theme I would say is that equity pricing is full, and we're seeing this across sectors, not just in real estate, but in real estate it exists too. Core pricing is above replacement costs in many markets. Pricing generally is over 20% in excess of 2007's peak. And cap rates are near historic lows despite the fact that there's been a 75 basis point increase in short-term interest rates last year. So all of that pulled together, and Odyssey, which is a compilation of US core funds, is targeting to return anywhere between 5 and 7% in 2018. So in an environment with basis protection but expensive equity, a natural place for an investor to explore is debt because of the subordination and how valuable that is in this type of environment. This chart represents market share of each lender type in the US based on new issuance in any given year from 2007 through 2017. A few things to note. CMBS dominated the lending community before the GFC on both the floating rate and fixed rate side for both stabilized and transitional assets. Since then, CMBS has normalized to about 20% of the market, plus or minus. But that's all pretty much on fixed rate stabilized assets. Life insurance companies and GSEs, which lend against multifamily in the US, are also really focused on that long-term fixed rate stabilized asset segment. Banks have really been the lifeblood of the lending community since the GFC. They're almost exclusively focused on floating rate lending. And while bank lending is increasing as a whole, the composition of that lending is changing, in part because of bank culture, but largely because of technical reasons, such as risk-based capital and regulatory changes. And then finally, alternative lenders, or debt funds, represent a surprisingly small but durable segment of the market. But the composition of what they've been doing has changed too. If you thought about what an alternative lender was pre-GFC, it was leverage upon leverage upon leverage upon leverage upon leverage, then repackage it and get some more leverage. And that didn't end well for most of the alternative lenders. Looking from the period of time from about 2010 to 2013, the real focus of the alternative lender universe was on that rolling wall of maturities, right? You had a situation where there was a lot of over leverage in the years leading up to the GFC, and they were going to fill the gap between traditional bank lending at 75% and equity to salvage projects at sort of 80 or 85%, and that was most of the focus of the debt funds in sort of that era. Today the debt funds really are focused on the space where banks used to play, but aren't playing today. Again, largely for those regulatory and risk-based capital reasons. So back to the banks. Bank culture has been keeping credit standards in check relative to pre-crisis levels, which is a healthy thing for the durability of the marketplace long term. This chart depicts broad bank lending parameters from pre-GFC to today across stabilized, transitional, and development assets. And as you can tell, there's been downward pressure on leverage across the board and upward pressure on spreads across the board. But this downward pressure is most pronounced on leverage in the transitional and development assets. Banks, broadly speaking, are lending at 15% lower leverage points than they were sort of pre-GFC. And this massive pullback has created the opportunity for alternative lenders to fill the void where banks used to play by providing gap capital. So here's how alternative lenders are taking advantage of the pullback in the market. And this is an illustrative example of a sample loan that an alternative lender would do. All these, the left box is sort of a capital stack at closing, and the right box would be a capital stack at stabilization. All these loans are structured to account for the in-place value at origination. So in this example, a borrower bought an asset for $100 and financed the asset with an alternative lender for $75. That lender then basically wrote the $75 loan in this example at LIBOR plus 385 basis points, and then sold the senior position into the bank market at LIBOR plus 225 to create a retained interest of LIBOR plus 850. With LIBOR where it is today and where it's going, and sort of origination fees that are associated with this business, that ends up corresponding to a yield to the lender of anywhere between 10 and 12%. These loans typically have future funding facilities as these assets are transitional. It might be a 70% leased office building in a 90% market, or it could be a Class B apartment building that needs $15,000 a unit in renovation or $10,000 a unit, taking the 1980 standard, up to a more modern, finish today. And those dollars will come with tests that basically make sure that the money that's going in is accretive. So at the end of the day here, while the lender's basis has gone up to 90, there's been value creation associated with that increased leasing or that renovation plan. And the value of the asset has jumped from an $115 basis to $130. So when you look at relative value, the first place to start is, well, how much deleveraging actually has there been in the system? So in this example, the loan to value is 69% at stabilization of where the lender is compared to where the equity provider has to be to make their returns. So we already know that this is good relative value in historic context because the alternative lenders are playing where the banks used to play, but how does it compare to the equity? So this chart represents the target returns in the marketplace for equity and debt on stabilized, transitional, and development lending. The debt returns are based on the mezzanine component of the stack, and the equity returns are levered equity returns to make them apples to apples. You'll immediately notice that the gap between debt and equity is surprisingly small in light of the incremental risk that equity is taking in today's market. In transitional lending, where most debt funds focus, the gap is about 200 basis points. It feels like a lot of incremental risk for the yield. Another interesting comparison is core equity to value-add debt. It's challenging to compare debt on a transitional asset to equity on a stabilized asset, because how do you compare the risk of getting from 70% to 90% leased, against the risk of taking, first dollar equity loss? But in the past few years, Odyssey had performed better, sort of that index of core funds. Absent last year, it had been double-digit returns, for the few that were leading up to that. So kind of in line with where debt or value-add lenders would play, and that seems like a more normalized, equilibrium. So in the past few years, so with the gap so pronounced right now, what we've been seeing from many investors is that people are pulling out of core and allocating core dollars to value-add debt, sort of trading off that subordination in exchange for a value-add business plan at returns that are in excess of what you can get in the core space. So I thought I'd turn it over to questions first. I have a couple of case studies if there's more time, but okay. So here are two case studies that are concrete examples highlighting the underwriting assumptions sort of required for the debt and equity in each component. This first deal is a development deal. It was an asset that was done in Brooklyn. It was a mixed-use project, multifamily with office and retail. The loan was 60% loan to cost, and the sponsor targeted 20% equity returns in the project. The mezzanine component earned about a 14% IRR at 60% leverage. So for the sponsor to make their 20% return, they needed to hold cap rates based on where they were in the market then, and believe in 3% annual rent growth. Not crazy assumptions, and this is not to disparage the equity in this transaction. The lender, for them to make their returns, they had a base case exit cap rate of 8.6%, 4% above the current market capitalization rate. Break-even underwriting rents could decrease 30%, and the cap rate could expand 2.5% for the loan to break even, inclusive of their return. These are all current pay vehicles. So, actually a great project for the equity, but on a relative basis, feels like the debt is potentially a better solution.
Second,
Sure.
what would the bank market have been? That 60% doesn't seem out of line with bank financing for construction. Was it because of the nature of the ultimate use, or why wouldn't a bank make that 60% loan?
So there's a couple of reasons. The first reason is that banks are increasingly focused on diversification in their portfolio, in our opinion, possibly to a fault. So as loans get bigger, there's generally less bank appetite to provide construction loans on scale. And then the second is the supply that was mentioned earlier on in the multifamily portion of the segment in New York. There is increased supply in New York. So the bank market here was really more apt to do a 45 or 50% loan than a 60% loan.
Okay, thanks.
And then this second example is a more traditional value-add asset. This is an office building in Philadelphia, and it was a lease-up play. Here, the loan was 78% of cost, and 98 million or 65% of cost was placed into the bank market. And the lender received about an 11% IRR, again, sort of on an all-in current basis. Again, a good project for the equity, and again, not to disparage the equity here, but for the equity to make money, they had to hold cap rates flat and underwrite renovated rents, because there was a capital improvement program, 6% higher than the baseline assumption, and occupancy 5% higher than the baseline assumption for them to hit that 15% return. For the lender to make its return of 11%, it had a base case stabilized cap rate of 8.8%, which is 2.3% higher than the prevailing market cap rates of about 6.5%. And rents could decrease 10%, and cap rates could expand 1% for the loan to break even, inclusive of interest. So we're at this weird paradigm in the marketplace where there's the confluence of two factors. You have banks that are pulling back for reasons that are unrelated to the underlying real estate, creating this opportunity for gap capital where the banks used to play. And at the same time, you've got excellent real estate fundamentals, but pricing for core that's somewhat high, which is forcing core returns down. So it's that paradigm of sort of this, where gaps between debt and equity and given segments of the market are not that large relative to what they normally are. And specifically with value add against core, value add debt is yielding much in excess of what core debt would, or what core equity would yield.